Welcome back to Morning Markets on Thursday, the 11th of May. Yesterday, all eyes were on the United States as we received the latest prints on inflation. A transition from an environment of inflation to disinflation is underway. There's reasons to be optimistic when we look at the data, but there's also reasons which challenge the Federal Reserve in their battle of bringing inflation towards target. So what did the data show? Well, on an annual basis, headline inflation, which is the broadest basket of inflation, continued to moderate. It moved on an annual basis from 5% to 4.9% at the end of April. And this has really been supported by a fall in energy costs. Energy costs as a basket were down around 5%. And it was components such as petrol, which were down 12.2%, and fuel oils, which includes diesel and heating oil, which was down around 20% on an annualized basis. Shelter and food continue to present upward pressure. These are the key culprits which we're seeing within this inflationary basket. They were up 8.1% and food was up 7.7%. Although if we do look month over month, that upward contribution has been moderating, which supports that annual inflation rate. Coinflation, which strips out food and energy due to their volatility because of the more seasonal aspects which they bring, has proven stubborn. It's actually running at a level which is 0.6% above headline inflation at 5.5%. And this is down very marginally from 5.6% in May. Again, it's shelter costs, but also transportation costs and the cost of service goods, which is really driving that upward pressure. To put this transition into context, headline inflation was running at 9.1% in June of last year, and core inflation was running at 6.6% at its peak in September. So we have seen quite a material step down in terms of inflation. So it is moving in the right direction. But if we just look at the month alone of April, if we look at the changes, then inflation was up 0.4%. Now, why is this a challenge? Because the Federal Reserve at this point in time need inflation to be running on a month-by-month basis of around 0.2% in order to hit their inflation target. Therefore, this presents a challenge to the market expectation that we could see interest rate cuts in 2023 in the US. In terms of the reaction from markets, 2-year US Treasury bonds, which are more sensitive to interest rate expectations, did moderate, so the yields came down around 15 basis points, so clawing back some of the returns through the course of this week, and then longer dated bonds, which are less sensitive, moved in around 5 basis points. So overall, a positive day for US Treasury bonds. If we look at the dollar was slightly weaker on the day given that moderation in yield, but also there was lack of progress in terms of the discussions on the debt ceiling between Biden and Congress last evening. In the US, positive day for stock market returns. That was largely driven by the Nasdaq, which is more sensitive and more positively sensitive if you see a moderating in interest rate expectations. So Nasdaq was up around 1% on the day. To look out for today in markets, update on the US producer prices, another angle of the inflationary discussion, labour market data, which is important for the Federal Reserve and their agenda, and here at home, the UK Bank of England decision. At this point in time, the expectation is we'll see a 0.25% increase in interest rates, but we'll continue to bring you up to date on this tomorrow here on Morning Markets. Thank you for watching.